Sure, what's up guys? Welcome back to the channel. Welcome back to another video. And as we start a new year of 2023 guys, I want to go ahead and throw in a new refresher to the Trading with Market Makers playlist and the strategy itself. So I think the best videos for this is going to be the Blueprint Summit videos. So what we're going to do is we're going to go ahead and start releasing these videos for you right here on YouTube. And we're going to start out with the Market Maker Foundations. So guys, do me a favor, drop a like on this video, leave a comment below, let me know your thoughts, and subscribe to the channel. And without further ado guys, enjoy the Blueprint Summit video, day one. All right, so first of all, welcome to the Blueprint Summit. All right, I appreciate all of you taking the time, number one, and wanting to just learn more about trading. All right, so let's go ahead and jump into this. So the first thing that I want to say about trading is that we're going to go over first the Market Maker Foundations. All right, what we need to know to essentially try to trade with market makers, right? Because we don't want to trade like retail traders. We want to trade with the banks. We want to trade with them. There's no possible way that we can win if we're trading against banks that have trillions upon trillions of dollars. There's just no way. Your $1,000 account, your $2,000 account, your $10,000 account is just no competition to try and trade against them. It just doesn't make any sense. All right, so what we're going to do is first we're going to cover the manipulation that happens in Forex. All right, so the whole Forex market, I'm sorry to tell you, is manipulated. All right, these are all controlled by banks. Okay, banks make the world go round right now, and unfortunately, they completely control the actual Forex market. So who are these people that I'm talking about? Well, the main players that manipulate the market, and you might have heard of them. So the first one and biggest one is Citibank. JP Morgan, so basically Chase. HSBC, UBS, Bank of America, RBS. That's the Royal Bank of Scotland. And then you have Bank of Japan, you have Bank of England. So all those are all players. But these are the major ones. These are what they're called prime banks. There's prime banks and there's lower level than that. There's prime of prime banks. So those would be like, the Bank of England, and others. But these are the main ones that are running the show. These are where all of the liquidity comes from. All right. So let's talk about market maker intentions. So what are the intentions that they have when it comes to the Forex market? What are the market maker intentions? So the first thing is, their goal is to essentially get retail traders to initiate panic and fear in order to get the retail trader to think with emotion. So you ever been in a trade or looking at charts and you feel that if you don't get in the trade now, you're going to miss out and you'll regret it later? Tell me in the chat how many times that's happened to you. That you've literally thought, if I don't get in this trade right now, I'm going to lose out and I'm going to regret it later if I don't get in this trade right now. All the time, right? This happens over and over and over. They play with your emotions. So they initiate panic and fear in order to get the retail trader to think with emotions and not think with their mind. All right. Second thing is they persuade you to take positions, right? They first initiate the panic and the fear, and then based on what you see on the charts, that nice big engulfing candle, right, and persuades you as a retail trader to take positions, right? And so when you take that position, you're simply taking it because you don't want to miss out on the trade. And the majority of retail traders end up taking the position at the most possible worst time. And so they end up chasing the trade. You end up chasing the trade. So the third thing that their intentions are is basically to hit your stop losses. How many times do you hear you take a trade and you put your stop losses where? Where do retail traders put their stop losses at? Right? Typically is right below the candle that they entered in, or right below the closest low. Right? And so if you're trading like a retail trader and your mindset is like a retail trader, the likelihood that you're putting in your trade at the right time is probably hugely incorrect. And you're taking the trade at the absolutely worst time possible because they still haven't hit the stop losses that they need to hit. And they still haven't cleared all of the orders that they need to clear. So when we get into the entries, exits, the patterns, we're going to talk about what is the timing aspect that we need to be in order to avoid the stop losses and avoid being in the path of when they clear the orders. Okay? And then finally, it's to force as many traders as possible into margin call. You have to understand that the majority of retail traders, right, they trade for obvious reasons because they want to make money. The problem is that the mindset of most retail traders is more of a gambling mindset than it is a profitable mindset. How many times have you guys taken a trade and immediately it goes against you? And maybe 5-10 minutes after it goes against you, it's still going against you, and you start to freak out over it. And you start to question absolutely everything about that particular trade. Because when you got into the trade, it was going in your direction. But it felt like as soon as you got into the trade, like somebody was watching over your back, and they're like, aha, Jamie just got into the trade. Or Joseph just got into the trade. How many of you guys have had that experience where you're literally, as soon as you get into the trade, it goes against you? And you're like, holy crap, did I take the right trade? You start literally guessing and questioning absolutely everything about the trade. I have literally witnessed and watched traders look at charts, look at a trade setup, explain everything about a trade setup perfectly, entry, stop loss, risk to reward, why they're taking the trade, confirmations, everything. They take the trade, and literally less than 15 minutes before even the damn candle closes, it goes against them 5 pips, 7 pips, and they start to automatically think about the trade itself. They start to second guess absolutely everything about the trade setup that they just took. That they literally just took 15-20 minutes explaining what are the reasons why they're taking the trade, how many confirmations do they have, risk management, risk to reward ratios, all that. And they still absolutely question it as soon as they go against you. That a large part of that has to do literally with the psychological mindset of trading. If you haven't noticed yet, the hardest mentally prepared type of job that you could have essentially is trading, because it plays such a big part in your psychological and emotional feelings. Because at the end of the day, you have something at risk, right? The risk that you put is basically your own money. And I don't know about you, but if you have a job, right, and you're working your butt off for 40 hours a week at a job, you get paid, and then you take some of that money and you put it into a trading account, and then you blow it. I mean, that's, money doesn't grow on trees. You work very hard for that money. So it hits especially hard. I don't care if it's $100 account. It just hits differently when it's real money, because you know essentially how much time and effort it took you to get that money to begin with. So now let's talk about what can market makers do. Okay, so it's very important that you understand and know what can market makers actually do. What are their powers essentially, right? Because they do have some type of power. And so we're talking literally about mostly brokers, the big brokers, right? So what powers do they have over anything that you do with trading? So the first thing that they could do is that they can requote your orders at any time. You place an order, and then as soon as you place the order to buy Euro USD, you get a requote pop on your screen. Now, most of the retail traders that I've seen or know are trading with brokers that are not regulated. And so they play by a different set of rules. Essentially, they can do whatever they want because there is no regulation to them. So if you haven't figured this out yet or not, when you're trading with an unregulated broker, the majority of the time, your orders never make it to the real market. So if you're trading with, all these brokers that are unregulated that give you 1,000, 3,000 to 1 leverage, all of your orders within those brokers never make it to the real market. They stay within their own ecosystem. They know that the majority of traders are going to lose. Over 90% of traders are going to lose their money. So your orders never make it to the market, and basically your orders are staying within that broker. And all they're doing is playing house money with your money. You visually see your order go into the market via MetaTrader, but those orders aren't actually going anywhere past the broker. The broker has all the stats. They know the percentage of their clients that actually make money versus the percentage that don't make money. So they know they can already pre-estimate how much money they're going to make. When you're with a regulated broker, they make all of their money via commissions and actual spread, right? So your orders, whenever you say put an order in and it's a market order and it goes in to the market in real time, when you're with a regulated broker, there's going to be times where you get requoted because the market is moving fast, especially if you're trying to place an order on a news event, like a heavy news event, like NFP or PMI or something like that. Something where you're gonna know that the volume is gonna be moving. So if you ever notice that your unregulated broker, anytime that you press market execution order and it goes through just fine, there's a reason why it goes through just fine and never gives you any kind of issues, because it's not actually going into the real market. So they can requote you. They have full control over the spread. Okay, they control the spread because that's how they make the money. The majority of the money they make is via the spread. That's why you notice that when you go into some of these brokers, you'll notice the regular pairs like Euro USD, Pound USD. Those are pairs that typically have the lowest spreads, right? But when you go into other currencies, like the more exotic currencies like USD ZAR, Pound NZD, or USD MEX, like the peso, they have ridiculous spreads, right? Because the liquidity is not there for those pairs. And so because the liquidity is not there, they have to give you bigger spreads. So they have full control over the spreads. The next thing is that they can trigger your stops, your stop losses in any range that they want. It doesn't matter where your stop loss is. If they want to hit the stop loss, if you put your stop loss where every other retail trader is at, I'm sorry, but it's probably going to get hit if you're trading at the wrong time. They know where your stop losses are, so it's easy for them to hit it. They can hold price level or extend it at any point. So if they want to hold price on pound JPY at 151.908 and they want to hold it there for an hour collecting contracts or other traders, then they'll do it. If they want to extend it down to like 151.850, then they'll extend it down to get more people to trade or get more orders to come in. In this case, for that difference, that would be for like selling before they reverse. And finally, they know which traders are in margin trouble. They know all this. They're your broker. They have a actual panel that shows them all of this. It shows them how many traders are in margin call, what's the percentage of traders that are long, short, all of that. They know all of this. Let's talk about, do market makers have restrictions? Or can they just do whatever the hell they want? Right? So to answer that, yes, they do have restrictions. Because if they didn't have restrictions, then our entire global economy would be completely in disarray. So yes, they do have restrictions. So what are they? So the IMF, the International Monetary Fund, restricts how much Forex market can move at any given time. This is typically per day, on a per day basis, right? So on average, the most that the market can move in one direction, right, where it doesn't completely jack everything absolutely up, is going to be about 200 pips per day. So 200 pips per day is typically what they'll be able to move. You ever notice that whenever you see a huge spike in a day where it literally goes like 200 pips, 187 pips or something in one direction, you're like, holy crap, what happened? But then you notice that the very next day, at least half of that move got retraced. You ever notice that? You ever notice that when you have a big move that happened, the very next day, there's a retracement that happens. And it literally is almost about halfway, if not almost the entire direction. That's because they can't move 200 pips in one day and then the next day move another 200 pips. It doesn't work like that because it'll throw off the entire thing. It'll throw off the entire balance sheet. So you may have a 200 pip move in one day, but you will certainly see some form of retracement the very next day. And so don't be surprised if you have 170 pip move on whatever, pound JPY, and then the very next day, maybe even during the Asian session, you get a 70, 80 pip retracement. Contrary to belief, they don't have unlimited equity. So they do not have unlimited equity. Now let's talk about what are the actual trap moves that they make. When do these moves actually happen? So trap moves are basically moves that are done in order to trap traders in going the wrong direction. Okay, so there's a couple ways that they do this. So think of the bigger picture first, right? Of trap moves are made at the beginning of the week and at the end of the week. So think of this like a 30,000 foot view of the market itself when you're looking at it from a weekly standpoint, right? And then you go down and you zoom in a little bit, and then now you're talking about the beginning of every day and at the end of every day. That's more like the 10,000 foot view. And then the close up view is going to be basically like the ground level view. And that's basically done at the beginning of each session and at the end of each session. So the trap moves are made beginning and ending of the week, beginning of ending of the day, and then beginning and ending of every session. So think of an example of this for like at the beginning of the week and at the end of the week. If you're looking at a trending cycle for a week, you'll notice that at the beginning of the week, let's say that this trending cycle went down, was a selling trending cycle. You'll notice that at the beginning of the week, they actually go up for a day and a half. Sunday, Monday, they go up. And then on Tuesday, they reverse during either the London or the US session. And they keep going down, sell, 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 sell the whole week. And then by the time Friday comes, you'll see Friday kind of come up and retrace some. And then just end, and just literally end in consolidation. Well, it's essentially the same thing for the day or the end of the day as well. It's the same thing. So this is where you'll see that you might get a type 1 setup, let's say, on pound USD. And once you get that type 1 setup, the false move that goes up, let's say, and this is the same selling scenario, the same move that goes up to falsely get people to trade, and then they automatically drop for the rest of the day. And then towards the end of that US session, they'll make a little reverse, and what typically happens, they'll consolidate the rest of the day, typically touching the 50, and they ride the 50 along. And this is the 50 EMA. So same thing, beginning and ending of each session. So the Asian session is probably the worst one, because all the Asian session is doing is moving back and forth between a certain amount of pips that they've set. And it's just back and forth, back and forth, back and forth for literally straight from the Sydney session, Tokyo session, and into the Frankfurt session. So what do these sessions look like? So these sessions look like this, right? Those are the trading hours. You have your daily reset where everything just resets at 5 p.m. Eastern Standard Time. And then the Sydney session starts. This is where you see the Australian dollar, where you see the New Zealand dollar. This is when they start to trade. You ever wonder why NZD pairs and AUD pairs typically have a pretty big Asian range of like 50, 60, 70 pips? It's because that's their trading session. They're supposed to move a lot during their trading session. Tokyo starts at 8 p.m. Eastern Standard Time. This is why you see the JPYs pairs move a lot, because they're supposed to move. That's their session. The problem is that the setups that we want are not happening in those sessions. The setups that we want are happening during the London and during the New York session. That's when we want to trade. That's where the most volume is. That's where all of the big banks are trading and making their moves. They're not making their moves during Sydney, Tokyo session. If you literally look on any chart, for the majority of the time, if we're not talking about NZD, JPY pairs, if you look at Euro USD, Euro Pound, Pound USD, Pound CAD, Pound Swiss, so USD, Pound, Euro, Swiss pairs, look at those pairs and look what happens, the movement that typically happens between 5 p.m. Eastern and 2 o'clock a.m. in the morning. Over 95% of the time, you're basically going to just accumulate and move sideways and do absolutely nothing. You're not going to do absolutely nothing. The majority of the time, the trade setups that we want are going to happen in London and they're going to happen in the New York session. That's when we want to trade. So essentially, now at least you have a structure to go by. So let me know in the chats, how many people here have a job? Majority of people have jobs, right? Perfectly fine. It's how you make your living. It's how you pay to feed your family, support your family, provide for your family. So the question becomes, if you have a job, what session right now is going to allow you to trade but still continue to work at your job? So to some of you may be London, to some of you may be New York. It completely depends on your job situation, right? If you work from home, let's say, then you might be able to get away with trading either session. So everybody's situation is different, but you have to identify what session is going to work for you. So for example, if you're working, during the New York session, right? Does it make sense for you to trade during the same time that you're actually working? It doesn't make any sense for you to actually trade during that session because you're busy doing something else. Your focus is on something else. Your focus can't be on working and at the same time trying to trade. Trading is already hard enough to do. So let alone you trying to pressure yourself into trading while you're working. That's not really going to work. So you know that if you're working during the New York session, well, guess what? Your trading is probably going to be done during the London session. Same thing, if you're working during the London session, your trading is probably going to be done during the New York session. No matter what session you trade, you can make money on either session. It's just the setups are going to be different for each session. So we're going to talk about the setups themselves that you should expect for London versus New York. But the first thing that you need to understand and try to basically figure out is, okay, what session am I going to be focusing in on? Because depending on the session, depends on the types of setups and the pairs that you might trade. So keep that in mind. Start to think about that. I know that most of you may have a goal of quitting your jobs and trading full time. That's going to take time for you to do. Just think about how much time does someone who goes to college or goes to school and is also working at the same time. A typical associate's degree, let's say, is 2 years in the US. A bachelor's is 4. Master's, what is it, 6 or something like that? And then PhD and all that stuff is way more. But during that time of you going to college and working at the same time, you can't do both at the exact same time that, the moment that you're working, you can't be doing school. So it works the same way. What you don't want to do is you don't want to be like, hey, I'm quitting my job. I'm becoming a full-time trader. Yes. And not even know what you're doing yet. All right. We don't want to quit your jobs The only time that you quit your job is once you have an actual plan in place of how you're going to do it, and most importantly, that you've consistently made either the same amount or more on a live account and you're trading. There's no way that you should be quitting your job if you don't know what you're doing yet. Because when you go to school to become a doctor, they don't just let you start operating on the first week of school. Any kind of profession, they just don't let you start doing it right away. You first have to study and get the book knowledge first. And once you get the book knowledge, then you can start practicing it. And once you start practicing it, that's how you get better. Everybody learns at a different pace. So for some of you, it may take years, it may take 2 or 3 years. I don't know. To some of you, it may take 6 months. Everybody's different. So do not worry or stress out about somebody else that's doing it faster or slower than you. Because you're not them. You are you, and you are who you are. So if it takes you 2 or 3 years rather than 8 months, that's how long it takes you. If I tell you that, hey, if you study this and after 3 years you can support your family for the rest of your life, would you complain about studying something and doing it for 3 years to get to that point? You know, if I tell you, hey, if you study this long enough and if you study the material and you practice over and over and over again, this market could literally be like a freaking ATM machine. It just depends on how much money do you want to take out. But do you think that getting to that point is going to be in a week or a month? No. It's going to take time. And how long it takes completely depends on how much time you put into it and how much effort you literally put into it. Does everybody that go to college graduate college? Does everybody that go to high school graduate high school? Think about how many people sign up to go to college. They have the best intentions. They have the best intentions to complete. They're super excited. They get into it. And then a couple months in, they're just like, yeah, this is not for me. Or, yeah, this subject sucks. Or, I really don't want to learn about this. This particular degree subject that I picked out. And so they might end up changing degrees to something that they're more interested in, right? So this happens all the time, every day, every year, with students that go to college. It is definitely something that you have to work at, and you have to have a plan in place for you to be able to succeed. If you guys have husband, wives, boyfriend, girlfriends, a significant other in your life, I strongly recommend that you talk to that person and you guys together put a plan in place on how this may look for both of you in the next 2 to 3 years. So, for example, when I was doing this and I was learning this and I was practicing, if I was by myself, if I was a single person, I would have failed easily because I would have quit my job way too early and I would have blown my account. So if you have a significant other in your life, married, boyfriend, girlfriend, fiance, make sure that they are included in the process. Talk about what are the goals that you want to set, whether it's a year from now, 2 years from now, whatever the case may be. But having their support is going to play a huge factor on how well you succeed or not. All right, guys. So that was the day one video. Again, the very beginning of all of the videos. There's so much more to come that's going to break everything down for you. So please hang in there. And I really hope that you enjoy these videos as I release them out to you so you can get a better understanding, or really a full understanding of our strategy and how we trade. Guys, until the next video, take care of yourselves, and we'll see you in the next one.